And so even when comparing on a sector by sector basis, equity wise, a given company or industry in the US is more expensive than its comparable company or industry in other markets. Um, and that's just, it's basically a function of where capital wants to be at this time. It's kind of seen as one of the only areas of growth, relative safety. But the risk is that investors are really paying up very high multiples for that safety. You can ironically turn a very safe investment into an unsafe one by overpaying for it. And an example that I point to, everybody's talking about Nvidia or the big tech, but I point to Costco. Costco is trading at 55 times earnings currently, despite being a 40-some-year-old, retailer. And Costco is a wonderful company. It's one of the few companies that is liked by shareholders, employees, and customers. I expect Costco to be doing amazing 5 or 10 years from now, but I would never pay 55 times earnings for Costco. There was actually a similar phenomenon back in the late 90s, which is, again, everybody focused on the tech stocks then. But if you look at Coca-Cola and Walmart, they were trading at over 50 times earnings in the late 90s. And they continued doing amazing in the 2000s, fundamentally speaking, but their stock price didn't, because their stock price would go from 55 down to 25 times earnings as their earnings doubled. So the stock price basically went flat for a decade. Um, and so the potential risk or opportunity, depending on how you look at it, that we potentially face in global markets is that we could see a pretty big rotation of capital out of the US and into other countries around the margins. And one of the few opportunities for this to happen is when the Fed enters a rate cutting cycle. And we've only had a handful of them over the past 20 years. We had the prior time they started a rate cutting cycle was in 2019. Before that was the global financial crisis, and before that was the aftermath of the dot-com bubble. So we only have like a sample size of three. And I think that this could be a pretty meaningful capital rotation in a similar way that the post-dot-com bubble was. Because the difference between that period and the later global financial crisis is that in those late 90s and early 2000s, a lot of global capital was stuffed into US markets. And so as the economy slowed down, as the Fed ran more dovish monetary policy, that allowed capital to flow elsewhere, encouraged it to flow elsewhere. Whereas in the global financial crisis, the US was already fairly underinvested globally. It was kind of the completion of that cycle. And so you didn't really see a repeat of that. And this is the first cutting cycle that really does look a lot like the early 2000s in terms of potentially encouraging capital to go elsewhere. So I continue to monitor some of these signs. And it's not the thing about this is it's a flywheel that becomes recursive once it goes in one direction. So for example, when capital leaves the developing world and goes to the US, it strengthens the dollar. And emerging markets have dollar denominated debts. And so their debts kind of appreciate relative to their cash flows, which squeezes them, which makes them look even less attractive to invest in. And so more capital wants to leave and go into safer markets like the US. But then that furthers that trend. It becomes a vicious cycle for them. And that can go on for 5, 10 years.